All right, here's a very warm welcome. Devang here from the Financial Analyst, and I'm here with an education video as you all requested. This is about how to take profits. I think it's very, very important. So, taking profits, or in other words, exit strategies. I think that's very, very important. I'll tell you why. Let me give you a background, small example. When you take a buy trade or when you take a short side of the trade, when you enter or when you punch in that order, you are so optimistic. You're like in your own fantasy world. You're in your own euphoria. Very small example. Let's say we buy Nifty today. Maybe we bought it at 4,900, and we're hoping it's because that we've bought Nifty. Tomorrow markets are going to rally 2-3%. We have no idea what's going to happen, but we have that point in the mind. Or let's say we go short on the market. We tell ourselves that no matter what, markets are going to plunge tomorrow, and we don't care about what's happening in the world. But because we are on the short side, we expect markets also to obey us. But we always forget markets are extreme. Why I'm telling you all this is, in this video, I'm not talking about how to enter a position, but I'm going to give you some methods or some strategies on how to exit a position. Because when you enter, it's as important, it's also very important, equally important, on how to plan and exit. Because if your exit is not proper, you might have made money, unrealized profit, in other words, but until you don't book that profit, it is not profit. It's just going to your broker. You're just paying charges. So as I always say, profit booking is also important at the right time. If you're sitting in a trade, if you're patient, it's important for you to understand when you need to exit. If you don't know when you need to exit, you're just wasting your time, you're just wasting your money, and you're just wasting your efforts. So this video is all about exit strategies and how to take profits. So this video is inspired by the work of Mark from UK Spread Betting. Totally awesome work that he's doing. And I wanted to bring out this concept that he introduced to people in India. And I hope you all enjoy this. So if you are waiting for more educational videos, if you enjoy this video over the course of the next 10-15 minutes, don't forget to like, guys. It won't take anything, just a click of a button. These likes that you all give me are what make me smile for no reason. It just brightens my day and shows me that how much love you guys have for us. And don't forget to comment. If you're new, don't forget to subscribe. It would make our day. It would mean a lot to us. So let's get started. Exit strategies, how to take profits. The number one method, I've written them all down, how Mark lists them. So the number one method of how to take profit is use a fixed target price. As simple as it is. Now, before I move forward, please understand, before I move forward these methods, please understand it's about being disciplined. These methods, some of them you are aware of, maybe you're aware of all of them, but it's about being disciplined. And you need to talk to yourself on what of these methods are you more comfortable with and adopt it. You might not make optimum money every single day in the markets, but it is not about making the optimum or the maximum return. Always remember, in the market, someone will make more money than you. You can't always be the market. Markets are supreme. You are a servant of the market. Think like this, and you might improve your psychology when you trade in the markets. So first of all, the first method which I like a lot of times is fixing a target price beforehand I take a trade. So let's say, I'll give you a very good example. Let's say I want to take a trade on Maruti, right? For the video, for the reference, I have the charts of 4-hour charts, meaning I want to take a swing trade, or for a couple of days, couple of hours also, could be anything. Now, I want to take the fixed target price exit strategy. What does that mean? Let's say I trade this breakout right here of this 7,200 zone. You can probably see that on the screen. Create great resistance. You can see markets multiply testing it. Also, you can see something like a good flag pattern over here, good consolidation, good range. And when this breakout happens, whatever the reason was, you already decide beforehand that if I enter Maruti for a swing trade, no matter what happens in India, no matter what the global markets do, no matter how much greed I have, I will exit, let's say, at 8,000 rupees. What's 8,000? I like round numbers. I think when you're fixing a price, round numbers are very, very good methods to exit. Round numbers basically mean a big fat number: 15,000 on Nifty, 33,000 Bank Nifty, 30,000 Bank Nifty, 10,000 Maruti, anything. Bajaj Finance, 5,000. I hope you understand the idea. Big whole numbers are round numbers. So, you talk to yourself and you say, I'm in a swing trade. And if I'm getting the momentum, why not wait till 8,000? Because a lot of times markets do respect round numbers. When I say respect, it means that they use them as, they basically treat them as support or resistance, and very strong ones. Best examples, ITC 200. I hope that is the best example I can give you right now. 200 levels of ITC, and it's worked time after time, right? And 240 numbers ITC. So rather than going for that points, you go for a big fat number. You take a trade, decide, and go for that number. Another example in this approach could be, I'll give you another example as approach. Let's say you divide your fixed target price, you base that on your risk reward. That's a very, very good way as well. So for example, you want to go long at this price. Why? Because you, number one, come to a great support. Number two, you see a good bullish engulfing candle at support. That's a double confirmation for you. So you put out your risk reward to long position, and you decide to go long at the top of that green bar on that day, 15th of March 2021. Why not? It's a great pattern, great support. ITC never breaks that support in the foreseeable past. So you have your stops below this low, because that's the rejection that you've seen on the charts, the maximum rejection that you've seen in the charts. So stops come here, which is about 10 rupees. So your targets could be based on that stop. Maybe a 10 rupee target, maybe a 20 rupee target. And you don't want to exit unless until you get that fixed target price. So whatever is your target, I don't know about that. So that's a fixed targets basically system that I'm telling you. Simple, but it's effective. So when we are in a trade, we don't accept it. We become greedy. So now you have to understand, it's not about being greedy. It's about what you decide beforehand, and whatever you decide, do not exit. Good methods could be 1:1, 1.5:1 risk reward, 2:1. But once you've said that, once you've logged that, it's done. And even if you move past that, you're not taking that trade. A good example will be, let's say you take a trade over here. Let's say the stop was around 6 rupees, and you said, I want a 2:1 target. It's favorable that way. You take a 12 rupee target because the 6 is a stop. You take a 12 rupee target, go for a 2:1 trade, and you exit somewhere here. Yes, ITC rallied above that, but it's not in your hands how much ITC can how much ITC can surge or tumble. So you accept how much was in your in your destiny, and you exit. Because always remember, you are here for a limited time. Your money, your capital, your time, but the markets will be there forever. So it's not you catching tops and bottoms that's important, but it's what is important is that you catch small movements on a consistent basis so that you can survive on a long-term basis. I hope the point number one is clear. The second example is an adaptation to this concept. So in this method, in the first method, as I said, we're using the fixed approach, the fixed time, and we don't care what happens there. The second approach is using this adaptation, which is basically we are judging or we are interpreting what happens at this fixed target price. I'll explain what I'm telling you. Let's open a very, very simple chart, Hindustan Unilever. I mean, I was just actually analyzing this chart earlier. And yeah, let's use this example. Let's say you went long somewhere at the bottom, maybe somewhere over here. You went long after this breakout, could be anything. I'm giving you a random example. And you said that my target is, let's say 2,500 round number. Again, let's use that fixed target price approach. You could use anything. Now, rather than just exiting at the fixed target price, in the second method, we are actually observing what is the behavior. So, which now basically gets in the concept of price action. What is the behavior? What is the psychology of the people involved at this price? Am I tearing through this price and giving a bullish candle? Because if I am doing that, it does not make sense to exit. Very simple. In the fixed target method, I am exiting no matter what. But in the second method, we are actually observing the psychology of buyers and sellers at that point of time. If I am getting a, so see this example, at 2,500, I hit this level. Maybe at that point in time, it's a very big green bar. But if I wait for the 4-hour closing, I get a good shooting star. If I'm getting a shooting star at my target price, what does that mean? It means that the sellers are becoming active. The buyers do not want to push past that barrier. So if that is happening, you know very well that you need to accept profit. You need to book your profit. And that's exactly what happened over here. Markets came and then they fell down. So rather than accepting that predetermined price, you observe the behavior. So two things can happen. Again and again, I'm saying two things can happen. Number one, One way is you get some rejections like you're seeing over here. In that case, you book profits. The other way could be there's a big green bar even piercing into your target price. In that way, you stay a little bit longer and you wait when that rejection comes in and then you exit. I can give you another example. Let's open a random chart. Tata Steel. I think these metals are the best example. So they've tumbled 5% today. I think the sector becomes, it's got a good double top actually on a 4-hour chart. We'll come to that in the weekend when I talk about that later. So let's take this example. Yeah, let's take this example. You can see over here, we can use some example like this. This was a range on Tata Steel. We had this doji candlestick earlier and maybe some rejections over here. So we have this good range in Tata Steel. Let's say you went long over here for some odd reason, or you went long at this double bottom breakout over here. If you use a fixed target price, maybe you want to exit at this highs, right? Which would be the recent high of your current past. But if you use a second approach, we basically are using how the markets are reacting at that price. And you can see over here, we got a good inside bar formation. So we got a good green bar, rejection, and then a breakout. So in such a case, I know that I want to stay in the trade longer rather than exiting. I want to stay in the trade longer. So I hope you're understanding what I'm trying to say. Another very simple example could be over here. Over here, let's say you're going short. We have a good range on Tata Steel. And let's say at this dark cloud cover or at this engulfing, you want to go short, any random reason. So you decide what's the target. You fix the target of these lows. And you can see at these lows, we are seeing hammers. We are seeing hammers, which means that buyers are not letting the price tumble down further. So if you're judging the price action at that point of time, you know it's not going to go down further. So you have to take profits. You have to exit there. I hope things are clear. It's simple, but something simple is always effective. You know, the most simple patterns in our markets are the most effective, but we always neglect them. So it's you who should actually, I learned this from David Bowden. You heard me talk about him a lot. So David Bowden was another very strong individual who practiced the works of W.D. Gann. And he said, always have attention to detail. You probably read that a lot when I'm on my Telegram channel commenting. So he said, I don't do extraordinary things. I do ordinary things extraordinarily well. What I'm trying to say that is, there are double bottoms and double tops. The simplest patterns which have worked for 100 years, more than that. But we don't pay attention to that. We want strategies. We want complex things. He said the same thing. He said, I don't do extraordinary things. I don't do complex things, but I do simple things extraordinarily well. So keep that in mind. These take profit strategies, they are very, very simple. But if you think about them, that's all you need to flourish in the markets. The next strategy that I can tell you for taking profits is an indicator-based exit. I mean, that's something I use sometimes, not a lot of times actually, but whoever uses RSI, stochastic, moving averages, probably is something for you. So what do I mean by that? Indicator-based exit. Let us go on Nifty. Let's take an example of the index, maybe a 15-minute chart, intraday example now. So let us say, let's use a good example. Let's take this example over here of longs. Maybe let's say, yeah, this example is fine. We got a good, you can see a breakout happening over here, and we went long somewhere at this point of time. Or you could say you went short at this point of time when the markets breached that. Now, how do you exit? You could use the first two ways, but you could also use the indicator-based exit. So you could use a moving average crossover. You could use stochastic. You could use RSI, Bollinger Bands. The list goes on. MACDs. Let me give you some examples, and accordingly, you can plan out for yourself. Let's use stochastic, right? Or let's use RSI. RSI could be an example. Again, these are not perfect methods, but they can help you be disciplined and stay in a trade long enough that you need it for. Let's say you went short at this point of time. Why? I see a good inside bar over here. You can see a big red candle, 1 o'clock institutional zone, and then you got a good inside bar. Markets go down, great entry. We go short at that point of time, another inside bar, another inside bar. So when do you exit? Very, very simple. So as long as the RSI is below 50, or below 40, actually, you know that the trend or that momentum is being dominated by the bears. When the RSI goes into the oversold territory, again, it does not mean you start buying. It shows that markets are extremely bearish. So you could take profits when the RSI actually enters back into the normal zone. it goes back above 30. So I'm not going long here. I'm not using that basic indicator strategy to go long or exit. I'm not using that. What I'm doing here is taking my entry on price action, taking my entry how it's supposed to be done, but using an indicator to actually plan an exit. I stay in the trade as long as the RSI says I'm oversold, I'm bearish, but I exit the trade when the RSI signals buying, or it gives me a good bullish divergence. Because of that, I exit. I can show another example on RSI. Look at this example. Very, very simple example. You get a good bullish signal over here, right? You go long over here. Markets have given you a breakout. And when do you take a profit? You're going long, 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 long. And at this point of time, when the RSI enters back the normal trading zone below 70, you take the profit. Yes, markets did the next day go above maybe 200, 300 points, but it's again not catching tops and bottoms. It's actually about getting some money, what is due in our destiny. I hope this RSI concept is quite clear. Can give you a same example maybe today as well. This is a great example. You know, this was a good support on the markets. The very first candle broke. Let's say you went short below the previous low, and as long as the RSIs are oversold, you stay in the trade. But as soon as the RSI enters back into the normal trading zone, when it becomes back, come into the normal trading territory, you take profits and you actually save this much money. So I think it's quite important. Very similar setup on even on the stochastic. If you ask me, very, very similar setups on stochastic. If I open stochastic, same indicators, but the similar indicators, not same actually, similar indicators, but kind of same setup. You can see, let's say you went short here on price action, not on indicators. I go short here on price action, and I will remain short as long as stochastic is oversold. When the stochastic enters back into the buying territory, I exit my trade. I don't hold it longer. And the same example, you can use it here also. Or let me show a good example on Bank Nifty. Let's see multiple charts so that things are clear. Let me show you a very good entry. Give me a second. Yeah. Okay, so this could be a very, very good potential idea. You can see over here, markets are at a very, very good support, right? And the markets are tumbling through this support. So what you could do is, as long as the stochastic stays oversold, as long as the stochastic is in the sell territory, you can go sell. So just give me a second. Let me, someone's calling me. Give me a second. All right. So what you could do is, you are remaining, you have price action, right? The price action tells you you can go short below this support, right? And when you go short, your price action says short, you can stay short as long as the stochastic is an oversold. And as soon as the stochastic enters back into the normal territory, that's a time for you to take profits. Very simple, but very, very effective. I hope that is very, very clear. Another example could be moving averages. I think they're very effective. Moving average crossovers, you have a particular number in mind, 20, 50. I'm not going to give you numbers. I'm not going to give you nugget hunting. You can always do a course if you're interested in that numbers. But any number, 20, 50, 50, 200, 10, 20, whatever numbers you like, 4, 9, 18, the golden crosses, 50, 200, whatever you like. So if they are signaling a change in trend, you take that and you exit. That's about the indicator-based taking profit strategy. Then I have another one, something very, very simple again, how to do a time-based exit. And that's again very important actually. I know not a lot of people use it, and not a lot of people have thought about it actually. And if you remember my last video, how to trade a couple of videos back, how to trade the first 1 hour volatility, this is exactly what I'm talking about. I hope you are able to code. If you haven't seen that video, make sure you see that. It's very, very important. Make sure you see that video. So the fourth method is time-based exit. Let me give you an example. So time-based exit, I'll give you some things I've learned. Let's open Tata Motors. I think the last time I gave you the same example, I can show it again right now. So Tata Motors. So this is something what we discussed last time. I said that if any momentum, again, you don't have to use it hard and fast, something I have learned and something I use in my setup, not every day, it depends day to day, but just for the sake of how to use time-based exit. So I have learned that whenever I take a BTST trade, whenever I decide at 3 o'clock, I want to take a BTST trade, I always have a time-based exit. That in the very first half an hour, 1 hour of the next day, I'm exiting. No matter what's happening. Markets might go 10% higher throughout the day, but I'm not concerned because I am not here to find tops and bottoms. I do not know how much a share can run up, but I know that If I have something right now, that is definitely worth two in a bush. A bird in hand is worth two in a bush. Remember that. I think it's very, very important. We don't understand that. When we are in the market, we're greedy, because a market is a place where the money is unlimited. It's unlimited. If you're in the right trade, you can probably make a lot of money. But if you're in the right trade but at the wrong time, you lose the money. So if I take a good BTSC rate, so you can see this trade over here, great breakout at 245. You get a good gap up. I exit in the very first 1 hour, because if I don't, markets tumble down back again. And same is the thing with when I trade the first 1 hour. Let's say I traded the first 1 hour trade. You can see over there, I didn't take the BTSC, I took the first 1 hour trade. So I have a rule for myself. If I am trading the first 1 hour, I will be exiting in the first 1.5 hours. I don't sit for too long when I'm in the trade in the morning, because I always see that they basically turn out to be reversals, or they actually, the trend does not last long, because I always believe that markets are opened by people like you and me, who do not have so much knowledge about the markets, but professionals at 1:30, they know what to do. So if a movement happens at 1:30, I find that concrete. But if a movement happens at 9 o'clock, 10 o'clock, I don't find that as solid. So if I am getting a breakdown at 9, 9:30, 10 a.m. Indian markets time, Indian Standard Times, I will take profits quickly, time-based exit. However, if I take a trade at 12:30, 1 o'clock, I will be willing to sit in the trade even for one more day, for a longer period of time. So time-based exits I am using. So I'm combining this with one of the other methods. So I use some other method of exit, but time is also very, very important. Another very, very good example I can show you is um, over here. I think this is the first candle. Yes. So you can see the 9:15 candle. The very first candle gave a great move. You can see it's a clean breakout. But if I stayed in the trade longer, I would have failed. I would have really failed. So if, as I said, if I take the trade in the morning, I scalp. I sit for 1 hour, 2 hours max, but I'm out. But if I take a trade in the later half of the day, I will be sitting for a long time. That's called the time-based exit, which helps me to take my profits. And finally, I'm basically scaling my momentum by using stops, trailing stops. I think that's very important. So this is the method I use. You've seen me use super trends. You've seen me use moving averages. That's the method I use. The fifth method I feel which is the most important is how can we scale the momentum? How can we go with the flow, go with the momentum by using trailing stops? And this is what Gann said. If you have read the works of W.D. Gann, in the book 45 Years in Wall Street, I can show you that book also. It's a very, very important book, 45 Years in Wall Street. This is one very, very good book by W.D. Gann. And in this book, he has laid out principles that he has followed in the last 45 years in Wall Street in the 1900s. And one of those principles, which I want to talk about, I'll do a video later about this book, maybe on Sunday. But just I want to correlate one very important principle that he said. Gann said that never ever take a loss. What does that mean? Does that mean you have to be right 100% time? No. He meant that when you take a trade, always trail your position. For example, let's say you take a trade 100 rupees and the of premiums of Nifty, and that premium went to 120. Gann says always trail stop loss at least to cost, so that even if the trade goes against you, you don't make a loss. And this way, think about it. If you keep using this method again and again, year after year after year, you'll actually save your account. You'll actually save your account. This is the biggest problem I would say the retailers have at this point of time. We never trail stops. We always think the momentum's coming. When the trade goes wrong, we sit in a trade for too long. Never ever average out a losing trade. That's what Gann said again. He said never ever pyramid or average a loser. If you are a losing trade, exit fast. But if you are a winning trade, trail stops, but also with the momentum, keep on pyramiding. Let me come to that later. So using that same approach, what Gann said in his book, 40 Years in Wall Street, I want to combine it in this method of how to scale momentum by trailing stops. There are many methods. There are many methods how you can trail stops. I can give a lot of examples, but that's not my job here. I hope people have understood the idea. I could probably use Nifty. Let's take Nifty. So let's say you're a swing person. You want to trade swings. You want to trade for a long perspective. For a couple of days, you are in futures or next month expiries. you are on a daily chart, and you can see very, very well that 20 MA a lot of time is a great support. So if you are trailing, if you've entered, let's say at this bullish candle, and when you come here, you trail stop below this low. When you go forward, trail below this low. I hope you're understanding what I'm saying. Just to repeat, let's say you took a trade somewhere over here. It's great if you're reaching this point of time at 20 MA, you trail below this 20 MA. Or what I'm saying is keep on taking your SLs with the 20 MA. I actually confused two areas. So there are lots of ways, just to repeat myself, to make myself clear, there are lots of ways you can scale the momentum by trailing stops. Number one is forget any indicator. You keep on using the swing lows to trail SLs. What I was saying in the first method. If you keep on going higher, use the swing lows and keep on trailing the momentum. And once you hit that, you're out. You're out, the momentum is gone. The other way is use MAs. Moving averages are the best ways. You can use a 20 MA, trail the momentum. As soon as you break in a 20 MA, you're out. You can use 5 MAs, you can use 10 MAs, the list goes on and on. If you're a guy who wants to trade for a long period of time, then maybe 20 MAs. If you're a person who wants to trade for an immediate scalp for a very short period of time, you can use 5 MAs, you can use 10 MAs. They stick to the price, but they're very fast, very quick. As soon as you're closing below them, you know you're out. You know you're out. You're not staying. You might have gone further on, but you're not interested because you're disciplined. Get that change in yourself. You can use super trends. I mean, you can use that. That's a very good approach as well. Super trends. You can use alligators. There's so many indicators. Super trends is another way. You can use, I'm not going to give you settings, but 10-3, the basic setting of super trend, that's good. 10 and 3, that's fine by me. For a long-term position trader, you can use 7 and 2. I think for a short-term guy, even 7 and 2 works for a lot of people. 7 and 2, it sticks to the price. It's fast. It's accurate. You can use that. So rather than staying in a trade and accepting, a fixed price, you can always scale the momentum out. And as you keep on going higher and higher and higher, you also keep on trailing stops, so you don't hit a loss. Even if you go wrong in the market, you don't hit a loss. You never take a loss in a trade. That's what exactly Gyan said. So that's about 5 methods how you can take profits. Let me know if that is helpful. Let me know if you can relate to these. If you found this helpful in the comments, click on the like button. And I love to do all videos again, more videos again like this. Thank you so much. As always, it's a pleasure for me and the team. And I will see you next time when I see you. Goodbye.